Welcome to the press report of the In Gold We Trust report 2022. My name is Mark Walek. This is my colleague Lonnie Stöferle.
Good morning here from Vienna. We've got lots of people all over the globe watching this press conference. Hi to South Africa, to New Zealand, where people told us before that they would be watching this press conference. We're all really excited about presenting you the highlights of this year's 16th annual In Gold We Trust report. When we decided on the leitmotif, the title of this year's report, a couple of months ago, we said that stagflation would be the topic that we would like to take a deep dive into. Back then, stagflation still wasn't really a big topic in financial markets. Now it is one of the biggest topics out there. And for us, writing the In Gold We Trust report is always, lots of work, many sleepless nights, and obviously this year it was especially demanding because over the last couple of weeks we saw in financial markets, on the bond side and on the equity side, 25 trillion of obviously paper worth being wiped out. So we are on the one side seeing asset price deflation, and on the other hand, we are seeing massive consumer price inflation. And this is basically the essence of this year's In Gold We Trust report. Now, I would like to thank, first of all, our tremendous team, 20 people working on 4 different continents. As I've said, we've got people in South Africa, obviously here in Austria, in the US, in Asia. So a big shout out to our team, especially Gregor, who's our editor-in-chief. Also our chart team, Lois and Richard, our support on the premium partner side and administrational tasks, Janine and Philip, who is responsible for the social media work. And thank you to all team members out there. You've been doing a tremendous job. And I would obviously also like to thank our premium partners. 20 companies supporting this report, and as you know, every year it is our vision and our aim to publish the best, the most interesting and thought-provoking, and also to some degree the most concise, but also probably the longest In Gold We Trust report. And this year we did hit a new all-time high with 420 pages in the German version and roughly 400 pages in the English version. And it wouldn't be possible to put out such a big report without the support of our premium partners, because we are putting out this report totally free of charge, because for us it is important to educate people out there about sound money, about the consequences of inflation, about portfolio insurance and so on. It wouldn't be possible to put out such a big report in English, in German, in Mandarin, and starting this year also for the very first time in Spanish. So we've got a Spanish edition of the compact version. And we also, as you know, we try to improve this report every year, and starting this year we put out a monthly Gold Compass. So that's a monthly publication where we show our most favorite charts. We've got lots of infographics. We've got fantastic threads on Twitter that will be published over the next couple of weeks that should deliver you the essence and the key takeaways of this year's report. And Mark and I, we published this report for many years now. I started in 2007, still working at Erste Group, and now we're pretty happy to publish every year what the Wall Street Journal called the gold standard of gold research. And this year we've got 25 chapters again, ranging from topics like obviously an analysis of the status quo, what's going on the inflation side, on the debt side, what's going on in regards to gold demand. Then obviously we've got a big chapter on stagflation, where we came up with our proprietary definition of inflation. We analyze what works in an environment of stagflation, what's the big difference between the current stagflation that we're seeing compared to the stagflation of the 1970s. Then we've got a great chapter featuring a timeline of the so-called de-dollarization. We've got two fantastic interviews. We write about safe gold storage, obviously about silver. We're coming up with a model by a guest contributor, Dietmar Knoll, a gold price prediction model. We analyze the challenges of the gold mining industry and the status quo of the mining space. We analyze the royalty and streaming sector. And also, of course, we talk about gold and ESG. So as you can see, it's quite a read. We really try to cover the topic of gold from all different angles and aspects. And I think we're, to a very large degree, quite happy and satisfied, and also a little bit proud about this year's In Gold We Trust report. Now, those are the key takeaways. I think Mark will start now with some considerations about the most recent performance. Then we will obviously talk about the core topic of stagflation, and then there should be plenty of time for Q&A.
Great, thanks, Ronnie. Okay, so let's have a look at the performance figures of gold. How did gold perform in the recent years? What we like to do is point out gold performance in various currencies, because obviously gold performance in US dollar is relevant, is important, but depending where you actually live, it may be even more relevant in a different currency. And the picture is quite interesting. So we saw since 2000 generally green numbers. So we have been experiencing a bull market since the year 2000. Although we had some bad years actually in the mid-2000s, but generally speaking, on average, performance was in green, except, as I said, mid-2000. And interestingly, also 2021. So last year was a little bit of a disappointment maybe in the gold price, and I'm going to talk a bit in more detail about that in a minute. But just also to see the most recent numbers, this year is also quite interesting. So we are seeing a divergence between dollar performance and basically the other currencies. Obviously, the reason for that is a very strong dollar recently and during the last year, actually. So we are seeing positive numbers in all other currencies, and dollar actually just turned back positive yesterday. So this is 2 days ago, but dollar basically year-to-date flat, and in the rest of the currencies in the green. Since last year's publication, again, the picture, what I just described now, just focusing on US dollar and euro, we have seen quite a nice appreciation of the gold price in euros. But we've basically seen a sidewards trend in the dollar. What one obviously can see is beginning this year, when geopolitical tensions increased and then actually also became quite imminent with the Ukraine war, gold actually managed to rally quite a bit. But since April, basically, gold is losing ground a little bit. And the question obviously is, why is this? So first, I'm going to explain a little bit our thoughts in regard to the gold performance 21. As I mentioned, that was may have been quite disappointed for some investors. Why? Because obviously gold is considered as an inflation hedge typically, and what happened in 2021, inflation really started kicking in. So what you can see here is price inflation when it started to increase during last year, and also the performance of gold in dollars actually didn't really react. So what are the reasons for this reaction or non-reaction? First of all, I think one has to consider the years 2020, 2019, basically the two prior years, which were very strong gold years. So we had performances, very high double-digit performance, so well into the double digits. And so gold was ripe for a breather. That's probably one reason. Another reason was, if you remember 2021, crypto assets were quite hot. There was a big debate if crypto assets will take over the place of gold, which till today they did not. So that has also faded away a little bit, but that also was going on back then. The dollars had started to become strong already, but for us, the most important reason actually was this whole narrative of transitory or temporary inflation. As you can remember, and this is actually still going on till today, the debate started in 21 when inflation started to increase and break the limits of the central banks, and that started mid-2021. And the debate was, is this inflation going to stay or is it going to be transitory? We, of course, said very explicitly that we don't believe that this is a transitory inflation. In fact, we called inflation to be going to come in 2020. So we actually published a special publication on inflation. Ron is going to talk about that in detail. But nevertheless, the narrative was this inflation is going to go away, and basically that also the gold market bought that. So to us, this is the most important reason why 2021 probably was a little bit of a disappointment. And one can see beginning of the year when this inflation rates didn't start to decrease, but continued to increase, that the gold price finally started to go up in the first quarter 2022. Very important for the gold development are financial investors, and these are represented by ETF holdings. So we always like to watch them closely. Global ETF holdings, quite interestingly, have topped basically the second largest central bank. So it's more than 3,500 tons now being held by global ETFs, mainly in the US and mainly in Europe. And also, again, the developments on here, I think, confirm what I just explained. After COVID, a lot of financial asset allocators bought ETFs, bought into the ETFs. But then in 2021, actually, they started selling again as actually the economy started to regain, and as long as the narrative of temporary inflation prevailed. And just recently, again, we can see that financial investors are increasing their holdings to gold via ETFs, and I think this explains very well how the price has developed recently. So this year has been very interesting also in terms of the other asset classes, and we have been witnessing quite some historic events. Ronnie mentioned 25 trillion US dollar wealth has actually disappeared this year, and that has been mainly, obviously, a function of falling equity and, very importantly, also bond prices. So bonds have been losing a lot of ground in terms of, in the context of rising interest rates, and at least the talk about rising interest rates. And this is also, I think, a very, very important fact. Obviously, we are seeing the Federal Reserve becoming very, very hawkish. They started to hike already in April, and they have communicated quite a hawkish path of future hiking. And most of the other central banks haven't started yet, at least the Western central banks. And in Europe here, we have this debate going on if it perhaps finally could come some kind of interest rate hike in July, and perhaps in the third quarter even a reduction of the balance sheet. But the US is much further in this process, and this, I think, explains the chart which you can see here. So when this hiking cycle started, that took an extra toll also on equity markets. So as we are speaking, we are witnessing 8 straight weekly loss in the Dow Jones. That's the longest weekly losing streak since 1923. So that's quite historic, and that, as I said, coincides with these interest rate hikes. And also, it also took a toll on the gold price, because that basically simultaneously started to decline. And bonds, as I mentioned, also are losing during this hiking process. So the big question is, first of all, how are the other central banks going to react? And when are they going to react? And going forward, is this hiking cycle going to continue? Just a look at the euro. What we saw in the Eurozone is the central bank expanding its balance sheet by over 4 trillion euro. So that's basically almost a doubling of the balance sheet. And in euro, the performance is quite decent of gold, because obviously the euro lost a lot of ground. And as I already mentioned, this is probably a very important point when it comes to distinguishing performance in euro and in the US, the divergent central bank policies. So a core message of us during the last 2 years, actually, and we are repeating this message this year, is that the great moderation has come to an end. So what is the great moderation? What we have been seeing during the last 4 decades has been basically disinflation. We've been seeing consumer price inflation, which has been gradually declining. So going back to the 70s, which is also a big topic of our report, we saw a big stagflationary environment in the 1970s in the US and also in Europe. And since then, and since the 80s, inflation rates have continuously been declining. And that was called the Great Moderation. And we expect that this actually has ended, and this has severe consequences for investors, for consumers, and also for central banks. And one of the big problems is that basically not many people, especially not many investment professionals, are still active who have experienced this kind of environment. So especially for asset managers or investors from the Western world, they are not experienced with big inflations anymore. They have forgotten the consequences, what consequences inflation can have on their portfolios, and that's why we took a lot of time to analyze what had happened in the 70s, what could be different this time, so we don't think there will be a total repeat of the 70s, and what one can do as investor. And with this, I pass on to Ronnie.
I think it's really crucial to understand that inflation is like kryptonite for bonds and for equities. And just to give you one fact, over the last couple of years, we've only seen 4 years where bonds and equities declined. As it seems year to date, 2022 will definitely become the 5th year in the last 100 years. So you can tell that for portfolio construction, inflation indeed is a big issue. Now, as Mark said, in 2020 we put out the report called "The Boy Who Cried Wolf." So basically, we mentioned this fable by Aesop, where the little boy warns of the wolf attack 2 times and nothing happens, and then the 3rd time everybody ignores him, but then the wolf actually attacks. And back then in 2020 we were kind of ridiculed because nobody believed in inflation to now finally happen, because it hasn't materialized over the last couple of decades during this great moderation, but then it actually happened. And it is exactly what central bankers always told us, that they want to achieve. They want more inflation. Inflation rates are too low. Deflation is the big enemy. Now the genie is out of the bottle. But now it's not only the wolf being inflation, it is also a bear that is attacking portfolios. And the bear represents basically an economic downturn that we're seeing at the moment. In the first quarter of this year, US GDP was already down. It was there were very, very positive forecasts when we went into the year, and then they were constantly being downgraded. Now for the second quarter, forecasts are also quite positive, but they're being downgraded as well. So from our point of view, stagflation, meaning elevated inflation rates and low growth, negative rate, stagflation is the environment that we all as investors, as asset managers have to prepare for. Now, when we crunched the numbers and when we started researching the topic of stagflation, we found out that there's actually no classic definition of stagflation. Most of them are quite qualitative. So we came up with a quantitative definition of stagflation. And just that I don't get anything wrong, our definition of stagflation is we define an economy as stagnant if real economic growth is less than 1% year on year. And we consider inflation to be elevated if it exceeds 3% year on year. We collect these data on a quarterly basis, and both conditions must be met for at least 2 consecutive quarters in order to declare stagflation. Now, what we did in this year's report, we analyzed which asset classes suffer and which asset classes really work in an environment of stagflation. And as we are being constantly told, inflation, well, it's transitory, it's a bit more sticky than expected. Madame Lagarde said it's a hump, it's an Hügel in German, a hump. It's a pretty big hump so far. And what you can see here is PPI, Producer Price Index for the euro area, and you can see it. Switzerland obviously is doing the best, but still here in the double digits. But for Austria, for France, for Germany, Italy, Spain, we are seeing the highest levels in decades. When it comes to the CPI, we just saw the highest levels since the year 1982. Just to remember, in 1982, we were 2 years old. E.T. premiered in US cinemas, and I think Helmut Schmidt was chancellor in Germany, and Super Trooper was on the first place, Super Trooper by ABBA, in the Billboard chart. So we're really seeing history being made when it comes to inflation. And ladies and gentlemen, for us it's really important to say that inflation has already been on the rise and was already elevated before the whole Russia-Ukraine crisis started. And now obviously Joe Biden is calling it the Putin price hike, and everybody wants to blame just the Russians. But it is important that this crisis, this geopolitical crisis, is just an additional driver for inflation. And what you can see here is the percentage of Russia's exports as a percentage of global production. Now everybody keeps telling us that Russia is not really significant. It's 3% of world GDP, something like that. But it is important to say that the supply constraints that we are seeing and the dependence of Russian exports when it comes to those crucial elements, those commodities, this moves an enormous amount of production. This moves an enormous amount of GDP. So it actually has a much larger effect. So from our point of view, unfortunately, as Europe is much more dependent on Russia compared to the US, I think the stagflation call for Europe is even stronger than for the United States. And in the report, we also emphasize that it's lots of different factors that let this inflation pendulum now really swing into the direction of inflation, whereas it was on the disinflationary side for the last couple of years. So it is obviously those supply constraints that we're seeing. Then obviously globalization is reversing. As globalization was deflationary, obviously deglobalization from our point of view is clearly inflationary. Then we're seeing that a wage price spiral is starting to spin. And I think it's really important, ladies and gentlemen, to emphasize that inflation has also a very strong psychological factor. The fact that people are now talking about inflation, that you see it basically everywhere, no matter if you go into a restaurant, if you go to the gas station, if you talk to friends about your vacation, whatever, inflation is a topic again. And I think it will be very, very sticky, and it will be challenging to get this inflation mindset out of our heads. Now, obviously, central banks now want to turn the corner by aggressively raising interest rates, and we already saw the consequences in markets. What you can see on these charts is all price hikes, rate hike cycles of the Federal Reserve, and actually, out of 20 cycles, 3 did not end up with a recession. So from our point of view, the recession call is pretty clear. The market expects interest rates in the US at, I think, 3.5% by mid next year. From our point of view, that's completely outlandish. And I think it's important to say, if we compare stagflation in the 1970s to the stagflation that we're experiencing at the moment, I think the most important factor is obviously the debt situation. In the 1970s, we basically saw half of the debt levels that we're seeing at the moment. So for example, on a government level in the US, it was at 35% in the US. Now we're at 123% on a state level. For companies, 50%. Now we're at 77%. And for households, for private households, in the 1970s up to the 1980s, 40%, now 76%. So the sensitivity to rising interest rates is higher than ever. So from our point of view, either central banks will have to make a very quick U-turn or will end up in a nasty recession. And it is not only a very aggressive rate hike cycle, it is also quantitative tightening that is now being feared by financial markets. Now, if you have a look at the history of quantitative tightening, what central banks communicated and the market expected and what that then actually happened, you can tell, well, you know, everybody was scared of the tightening, but then it didn't really materialize. And as soon as the next crisis started, the Federal Reserve had to become very, very dovish again and basically significantly increase their balance sheet. So from our point of view, we don't really see quantitative tightening materializing because the market is already telling the Federal Reserve, well, we don't like that. And as you can see on this chart, obviously, global stock and bond markets are highly dependent on liquidity. There's a very high correlation between the aggregated balance sheet of the most important central banks and the global stock and bond market. And you can tell this hawkishness, this reversal, this quantitative tightening hasn't even started yet, and already markets are telling central banks, no way. If this should continue, we're going to continue selling off. And this will have tremendous effects due to the so-called reverse wealth effect. It will lead to demand destruction. It will lead us directly into the next recession. Now, as I've said before, stagflation is a tough environment for portfolios. What you can see on this chart is the Schiller PE ratio for the S&P 500. And obviously, high valuations are only to be seen in years of moderate inflation. So valuations don't really like deflation and they don't really like high inflation rates. Now, for us, it's important to make the point that when it comes to your equity allocation in times of inflation, it doesn't necessarily mean you should sell all your stocks, but you have to become much more selective than in a low inflation environment. You have to focus on the sectors. You have to focus on the pricing power of companies. And as we saw, for example, now recently, this week with Walmart and Target, they've been selling off big time, although everybody said, well, you know, everybody will continue to buy groceries and stuff like that. You can tell that consumers are already feeling it. They're already maxed out. So our message is, in an inflationary environment, you have to be much more cautious about your equity allocation. Now, as I've said before, we had, over the last 100 years, only 4 years where equities and bonds sold off, and it seems that this is the 5th year. Now, what works in such an environment? Actually, gold does work pretty well in such an environment. I think we wrote last year for the first time that gold is the Robert Petzl of your portfolio. Now, this only works for people that have an affinity for Austrian football, for Austrian soccer. So we could also regard it or name it as the Virgil van Dijk for portfolios. But you can see that gold does a pretty good job in defending your portfolio, in making sure that to balance the losses that you're seeing on the equity and on the bond side. And this is really one of the core topics of this year's report, that as soon as inflation becomes a topic, this correlation between equities and bonds suddenly shifts. And then you really need a portfolio diversifier. Now, what does actually work? As I've said, we calculated those proprietary stagflation periods, and we crunched the numbers. And actually, the average annual real returns of gold, silver, and especially of the BGMI, so the Barron's Gold Mining Index, looks pretty well for those environments, and especially also for the 1970s, this stagflationary decade. Although one has to say the 70s were obviously quite special, as Richard Nixon, as you all know, temporarily closed the gold window, and there was so much pressure due to this undervaluation of the price of gold, and this pressure was released in the 70s by aggressively or strongly rising gold prices. But it is important to say, I think, in times of stagflation, gold, silver, and especially miners should do their job pretty well. Now, when it comes to commodities, we analyzed the commodity sector at length in this year's report. And I think it's also important to emphasize that this commodity bull market basically already started in 2020. And we had a tremendous bull market in commodities last year already, despite the fact that the US dollar was so strong, despite the fact that the Chinese were pretty hawkish. So actually, this commodity bull market is on a very strong foundation. And as you can see on this chart, you know, we enjoy analyzing the big picture. So this is more than 100 years of time series. Normally, those cycles in the commodity space are pretty strong and take many years, if not decades. And we always go above the previous all-time high. So now we're still below the previous all-time high. So it would be a surprise for us if this time around it would be different. And it's important to emphasize that this bull market in commodities is mainly driven by the supply side. We saw a nasty 12-year bear market in commodities. Nobody invested in the commodity space. You've got a lack of capital, a lack of human resources, and this is now really being one of the primary drivers of this commodity bull market. And commodity companies are doing pretty well. As you can see here, those are truly free cash flow monsters. This is the largest commodity producers in North American markets, everything above 1 billion market cap, so excluding the junior space. Those are really producing companies, and you can tell, well, those companies are making lots of free cash flow. And when it comes to the gold miners, in this year's report, we actually say that there's enormous challenges for the mining space. You have to be very selective, but in general, the companies are making good money at current gold prices. They're making good money, but on the other hand, they're still largely ignored by financial market participants. Mark, as you're primarily managing our funds, I would say it's your turn as we briefly show what we did in market.
Thanks, Ronnie. We just wanted to give a shout out to one of our strategies, but not so much to specifically this strategy, but this is basically what we have been saying for quite a while, I think. Diversify for inflation. And there have been quite a few strategies out there, but not that many again, who have been very helpful in this environment. And they, as we also do, consist of inflation-sensitive assets, which are mainly commodity driven and related. So this is perhaps one of the essentials also from the messages from the report. Real assets, gold obviously, but there are different assets which have perhaps similar properties as gold, but which can diversify your portfolio during a stagflationary environment. So we've got coming to an end here. Got a very long-term chart here with gold price, and especially also adjusted for inflation. So this is the official inflation rate. So let's stick to those. But even with the official inflation rate, the gold price is still well below its inflation-adjusted all-time high, which was in 1980, which would be comparable to roughly $2,427, and we're currently at 1,850. So also from this perspective, gold could have quite a significant run still. What we concluded with is obviously our gold price model and our target. This model we first published 2 years ago in 2020. And what we said back then is that we were going to have a gold price approximately at 4,800 at the end of the decade, so at 2030. Obviously, we are only 2 years in this race, but so far the direction has been looking well in our favor, what we said basically. Currently, we're a little bit below this trend. If one wants to extrapolate this trend, one would have to actually be at 2,200, close to 2,200 at the end of the year. We think that is also quite a good intermediate target, although what we also wrote is that we could imagine that we have still headwinds in the short term of the gold price, because as we hopefully communicated clearly, for us it's going to be key how this rate hiking cycle in the US and elsewhere, but especially in the US, is going to develop. And provided this currently priced in rate hike cycle is not going to materialize in this manner, we think that this is a very realistic target for the end of the year. So I think with that we can actually start to conclude. First conclusion is the great moderation is over. Decades of disinflation are probably going to be now followed by maybe a whole decade, but definitely years of higher inflation. The Fed acts late, but now decisively, at least for now, and this brings other central banks severely under pressure. It will be a balancing act of fighting inflation without triggering distortions in the markets, and I think this already by now should be quite clear that this is probably doomed to fail. So it's probably not possible to hike rates without having at least a bear market, or probably much worse also a recession. The inflation wolf, as we compared it to, is now getting accompanied by the recessionary bear. So our call, very obviously, for a stagflationary environment, which we're probably going to see pretty soon in Europe and also in the US. But for Europe, it is a very high certainty in our view that we're going to see a stagflationary environment. Longer-term environment of high inflation, we expect these inflation numbers to stay elevated, as I said, but importantly also, we expect waves of inflation. So this is something what one saw in historic precedents. when one enters a higher inflationary environment, these inflationary numbers don't stay constant at 3, 4, 5%, but they tend to come in waves. And this we also expect, so we actually expect that this, and this is the next point, the current wave of inflation will reach its peak this year. So inflation numbers may peak out this year, but the next wave is likely to follow once central banks can't react, or once it's obvious that they can't react appropriately to stop this inflation. A crucial question for the gold price: when will monetary tightening be stopped? And as I already said, by the end of the year, our gold price intermediate target is $2,200, and we confirm our target for 2030 at 4,800. Anything else to add?
No, just a big thank you to everybody watching this press conference here. Big thank you to all our premium partners and everybody involved in this report, our whole team. And now I think there's still some time for questions. Thank you very much. Any questions?
Yeah, we have two questions. The first one is, do you consider it likely that the price-wage spiral will be triggered, of which many are afraid? And the second one is, what long-term consequences, if any, could the freezing in of Russia's foreign exchange reserve have?
Well, starting with wages, I think it's pretty obvious that this spiral is just starting to spin, and we will see the negotiations. But I think it's quite obvious that it will materialize, and I think obviously that's also what we write about in the report. When it comes to the labor market, of course, unionization is here for a way lower degree compared to the 1970s. So unions had definitely a much stronger presence in the 1970s. But on the other hand, in the 1970s you had this demographic dividend, while now you're having those demographic headwinds. So actually I think it's quite obvious that inflation is, or that the price wage spiral, or the wage price spiral as we call it, is starting to spin, and this is really another big driver of our inflationary outlook.
Right, regarding reserve assets, that's actually a topic which we have addressed extensively in the report, because as you stated, Russian reserves have been frozen, and that was quite an unprecedented move, at least regarding a country of that size and of that international importance. We haven't seen such a kind of move, and I think it is going to be monitored very closely by a lot of countries, especially from China, who has which has a lot of reserves in US dollar, as is well known, and this makes a really good case in our view for a neutral reserve asset which cannot be seized, especially as it seems as if we are going into kind of a new Cold War, at least two geopolitical blocks which seem to be developing, and there will come the question: which neutral reserve asset can at least enable some kind of a trade between these blocks and so on. And due to its properties and due to the history, obviously gold will play a role. It's pretty likely that gold could play a role, and we can see obviously also from the eastern part, Russia, China, that they have increased their reserves already since years. but we're also seeing smaller Western countries increasing gold reserves. So definitely, in our view, this action is going to promote gold as reserve asset.
If there are no other questions, then we sincerely thank you for your attention. Greetings here from Vienna to our international viewers. All the best. Good morning or good night, wherever you are. We hope that you enjoy studying this report. And yeah, if you have any questions, please don't hesitate to contact us anytime. Thank you very much.
Thanks.